for problem number 1. So you will involve similar figures and even similar solutions for the worksheet for requirement 1, requirement 2, except for very few discrepancies. That depends on the journal entries and elimination entries. So what I will be giving you now will be the original entries to be recorded by the parent, and as well as the elimination and adjusting entries to be recorded upon consolidation. So with that, you will be familiar with the entries that will be reflected in your working paper. Okay, so let's now begin with the journal entries using the equity method. The journal entries using the equity method, which are already part of requirement number 3. In requirement number 3, whereas your another set of entries are already part of requirement number 5. Okay, so I hope you understand why we only involve the entries so we can finish in short time, because only the journal entries differ. That will have an effect on your working papers. So we now begin with, I'm going to start with partial goodwill under the equity method. So again, under the equity method with partial goodwill during the first year after acquisition. So repeat, we now involve preparation of journal entries under partial goodwill during the first year. Remember, we are now dealing with the equity method. Okay? So what are the entries during the first year or 2000 X4? First year after acquisition. That will now involve the entries of the parent under the cost, under the equity method this time. So we now begin with January 1, 20 X4. January 1, 20 X4. Supposed to be, no? You have the entry debit, investment in S company, and credit cash. Investment in S company and credit cash for the consideration paid by P company. The amount of 372,000. That's given in the problem. So debit, investment in S company, credit cash, 372,000. Okay, the entry on December 31, 20x4. The entry on December 31, 20x4. The entries on December 31, 20x4. Entry number 1, debit to cash, credit investment in S company. Debit to cash, credit investment in S company in the amount of 28,800. In the amount of 28,800. So taken by multiplying 36,000 by 80%. 36,000 by 80%. Now the explanation, record dividends from S company. Record dividends from S company. That is the first entry on December 31, 20 X4. The second entry on that same date is to debit investment in S company and to credit investment income. Debit investment in S company and to credit investment income for 48,000. It's the result of multiplying 60,000 times 80%. 60,000 is the net income of S. So multiply that by 80%, you get 48,000. So you have now to record the share in net income of subsidiary. To record the share in net income of subsidiary, 48,000. Next, entry number 3. On that same date, debit investment income and to credit investment in S company. Debit investment income and to credit in investment in S company. Debit investment income, credit investment in S company for 13,560. 13,560. How was the amount taken? 13,200 times 80%. 13,200 times 80%. And we add 3,750 minus 750. So I'll repeat, you multiply 13,200 by 80%. Then, the product of that, you add to the difference between 3,750 and 750. I believe you are familiar with the amounts because these also were the amounts that we involved in problem 1. So if you can recall, 13,200, that's now your over-under valuation in your asset and liability accounts. And 3,750 is your goodwill impairment, and 750 is the share of the NCI. So I'll repeat, the last entry, debit investment income for 13,560 and credit to investment in S company for 13,560. So your explanation will be to record amortization of the over-under valuation, to record amortization of over-under valuation in inventory, equipment, building, and bonds payable. So inventory, equipment, building, and bonds payable, comma, and impairment loss on goodwill. And impairment loss on goodwill. And impairment loss on goodwill. Now remember, this time we are using the equity method. Unlike in problem number 1 that we use the cost model. If we use the cost model, we just debit the investment account for the original investment. any other dividend or income derived from subsidiary, we do not record that in the investment account. That's the main reason why we call it the cost method, because the investment account is recorded at its original cost. Okay? Whereas under the equity method, the investment account should be adjusted to conform with the amount of the equity as of the certain date. So that under the equity method, the investment account will be debited for the cost of the investment, will also be debited for the share in the income of the subsidiary, will also be credited for the dividends received from the subsidiary. And in this problem, the investment account is also credited for the amortization of the allocated excess. Though in this case, we have to credit investment. In some instances, we may still debit it. So, this tells us that under the equity method, the investment account, the balance of the account should be adjusted to conform with the balance of the equity as of the certain date. So that in the problem, if we try to analyze the investment account, the investment account in entry on January 1 was debited for 372,000. Debit 2. On December 31, 20x4, the investment account is debited, no? And at the same time, credited for the following. So in entry number 1 on December 31, we credit the investment account for 28,800, the share of the parent in the dividends of the subsidiary. Then we also credit the investment account for 13,560 for the amortization of excess of inventory, equipment, building, bonds payable. So we credit to investment in S company. Now, the two credits were made in entry number 1 and entry number 3 on December 31, 20x4. Likewise, we debit the investment account on December 31, 20x4 for the share of the parent in the net income of the subsidiary in the amount of 48,000. So what we are going to do now, the debit in the account investment in S, 372,000, then another debit for 48,000. We get the total equal to 420,000. And then we deduct the credits, 28,800 and 13,560 for a total of 42,360. So debit minus credit, the balance of the investment in S at the end of 20x4 is 377,640. So 377,640 7,640. That is the balance of the investment account, investment in S at the end of 20X4. Also, the investment income account has the following credits and debits. Investment income has a credit of 48,000. That's entry number 2 on December 31, 20X4. Credit investment income, 48,000. Then debit investment income, 13,560 in entry number 3. So entry number 2, credit 48,000, debit 13,560. So that your investment account has still a balance of 34,440. 34,440. Now you take note of these balances as we will need this in our elimination and adjusting entries. So we are now through with the journal entries in 20X4 under the partial goodwill approach, under the equity method. So meaning we are done with requirement number 3. The journal entries as stated, prepare the journal entries for 20X4 under the partial goodwill under the equity method. So we have those 4 entries. Now, I hope you understand the importance of your journal entries as this will guide you in the preparation of your working papers. Now, we go to the requirement in number 5, in the consolidation work paper. In the consolidation work paper for 20X4, that's the year of acquisition. Still, we are using the partial goodwill approach and the equity method. Okay, so we now go to the consolidation and adjusting entries. Number 1 entry is to debit common stock of S company. Debit common stock S company. Debit retained earnings S company. 240,000 and 120,000. So debit common stock 240, debit retained earnings 120, credit investment in S company for 288,000. Now that's the result of multiplying 360,000 by 80%. So credit investment in S company, 288,000, and credit non-controlling interest for its 20% interest. So credit non-controlling interest for 72,000. Okay? That's the first elimination entry. And your explanation is to eliminate intercompany investment and equity accounts of the subsidiary, to eliminate intercompany investment and equity accounts of the subsidiary, and to establish non-controlling interest on the date of acquisition, and to establish non-controlling interest on the date of acquisition. Okay? So again, debit common stock 240, debit retained earnings 120, credit investment in S company 288, and credit non-controlling interest, 72. Second entry is to debit inventory, 6,000. Debit inventory, 6,000. Debit accumulated depreciation equipment, 96,000. Debit accumulated depreciation building, 192,000. Debit land, 7,200. Debit discount on bonds payable, 4,800. Debit goodwill, 12,000. Debit goodwill for 12,000. And we now credit the building account for 216,000. Debit credit building for 216,000. Credit non-controlling interest or NCI for 18,000. Credit non-controlling interest for 18,000. That is 90,000 times 20%. That is the non-controlling interest, 18,000. And finally, credit investment in S company for 84,000. 84,000 being the difference between 372,000 and 288,000. So we have now to allocate excess of cost over book value of identifiable assets acquired with remainder to goodwill, and to establish non-controlling interest in net assets. I'll repeat the entry. Number 2, debit inventory, 6. Debit accumulated depreciation equipment, 96. Debit accumulated depreciation buildings, 192. Debit land, 7,200. Debit discount on bonds payable, 4,800. Debit goodwill, 12,000. And credit to buildings, 216,000. Credit non-controlling interest or NCI, 18,000. Credit investment in S company for 84,000. Now, you try to check the quality of your debits and credits. We are dealing with journal entries. And in the consolidation working paper, you will still involve the same consolidation working paper as that in problem number 1, only that your elimination entries will be as we are having now under the equity method. Okay? So we now go to entry number 3. In entry number 3, debit cost of goods sold, 6,000. Cost of goods sold, 6,000. Debit depreciation expense, 6,000. Debit accumulated depreciation buildings, 6,000. Debit interest expense, 1,200. Debit goodwill impairment loss, 3,000. Debit goodwill impairment loss, 3,000. Credit to inventory, a debit. This time, repeat. Goodwill impairment loss, 3,000 debit. Credit to inventory, 6,000. Accumulated depreciation equipment, 12,000. Discount on bonds payable, 1,200. Credit goodwill, 3,000. I'll repeat the whole entry. Debit cost of goods sold, 6,000. Debit depreciation expense, 6,000. Debit accumulated depreciation buildings, 6,000. Debit to interest expense, 1,200. Debit goodwill impairment loss, 3,000. Credit inventory, 6,000. Credit accumulated depreciation equipment, 12,000. Credit discount on bonds payable, 1,200. Credit goodwill, 3,000. Explanation: to provide for 20x4 impairment loss and depreciation, to provide for 20x4 impairment loss and depreciation, and to amortize differences between acquisition date fair value and book value, and to amortize differences between acquisition date fair value and book value of identifiable assets and liabilities, and to amortize